Hello and welcome to India Tonight with me, Ankur Mishra and Shivani Gharat. Let's shift focus to the story of the day. Yes, we are talking about markets and markets are bracing for a wild ride as global events collide, sending asset classes into turmoil. Heightened volatility fueled by Fed policy uncertainty, geopolitical tensions, and fears of an AI bubble burst is hammering everything from equities to crypto. Tech's magnificent 7 are leading the change downwards, tumbling from their 2025 peak amid fading AI hype and hedge fund sell-offs.
And then a hawkish Federal Reserve is piling on the pain for the precious metals, including gold and silver. And Bitcoin, of course, it's mired in its longest losing streak since 2024, down by 26% to around $83,000 on Fed repricing and $1.2 billion in ETF outflows, with an analyst, in fact, eyeing a potential dip to $70,000 before any rebound. We discuss all of this and more. Joining us, we have David Roche, who's a strategist at Quantum Strategy, and then on the other side, we have Sudip Bandopadhyay, who's a group chairman at IndiTrade. Both of you gentlemen, welcome to ET Now. And let's begin this conversation with you. First up, the topic of discussion the whole of the last week was, of course, a significant run-up in the stock prices of all the tech and AI-focused companies. That has led investors to worry about the sky-high valuation, whether AI is in fact a bubble that was forming over the past few months. So, David, my first question to you is, given your view on what is happening in the AI sector experiencing the bubble, and that 20% market drop could occur in 2025 and going forward in the coming months. What specific metrics tell us are you monitoring to determine the precise timing of this potential crash, David? And at what points should investors pivot from your recommended safe havens?
Well, that's a lot of things. Let me answer the questions without being pretending to be somebody who's a guru and can give you market timing. I think I'd approach the issue like this. There are always, when you look at a bubble, two aspects. Number one, you have to find the credit bubble. And number two, you have to find an asset bubble, both sides, in a sense, of the national balance sheet. Well, the credit bubble is, of course, non-financial credit, non-financial institutional credit, i.e. credit which is being created outside the banking system. And that is now equal to about 4 times US GDP, and it's grown by 100% in the last 10 years. Then on the other side of the balance sheet, you have AI. And the problems there, I think, are not that AI isn't useful. It is useful. And it does increase productivity. But the question really is too much money being poured into this in America, creating bubble conditions which are more based upon the ego of the individuals involved than the economic reality? And the argument for that is really the comparison with China, where they have created almost an equally good AI with a tenth of the money. So is there not an issue for saying that the AI bubble is there at the same time? It's not so much a bubble of the asset being useless. It's a bubble of the asset being overpriced in terms of the capital being put into it, and therefore that it will not earn the rate of return which is necessary to maintain current valuations. Now, you asked me when's this going to happen, and I think within the next 6 months of this year, but I wouldn't think it's all going to happen now. And what do I look for? Well, obviously on the AI side, I look for disappointments in terms of being able to earn money on these vast amounts of capital being poured into the system. So I would watch the AI sector very, very closely for disappointing announcements about the ability to monetize all of this capital investment. And on the credit side, well, it's always the same thing. You have to look for a pivot point in the Fed or interest rates going up, or you have to look for defaults. or you have to look for fraud. Those are the three things that bring down a credit bubble. Rising interest rates, cost of capital, you have the question of bankruptcies, and you have the question of fraud. So that's my answer to your question. I hope it's okay.
Yeah, you are saying 6 months or now. It can happen anytime. But more importantly, Sudip, I want to come to you in terms of what the data suggests currently. If you look at Dow Jones, it's around 9% up year to date. If you talk about our own market, we have crossed 26,000 many times comfortably, or just shy of lifetime high, which Nifty would have done. What I'm trying to imply here is it a fair assessment or suspicion of whether or not we are going into downwards trajectory?
Not really. I think Indian market dynamics are different. We don't have, the AI trade as such in India. Unfortunately, I think Indian companies have missed that particular bus, and the valuation of any script because of AI hasn't moved up really. There are a little bit of here and there as far as data centers are concerned, and valuation bubble may be building in values data centers, but that's a very, very small piece of Indian capital markets. As far as Indian capital markets are concerned, there are two things which are happening. When there is a challenge as far as US AI is concerned, and there is a fear of a bubble, and things are, like what is happening now, prices of the Magnificent Seven is coming down. India is a kind of anti-AI trade, and you'll see that Indian IT companies, which are not really there as far as AI is concerned, their valuation, their prices are moving up. So I think, when there is an AI bubble, kind of a downward spiral, Indian IT companies are benefiting. That's what we've been seeing time and again, because Indian IT is not in AI. The second thing which Indian markets are eagerly waiting, and to an extent it is getting factored in the market, is a US-India trade deal. I mean, it's completely different from what we are discussing, but that is one thing which probably will change the mood of the FIIs towards Indian investment in Indian equities. It may not have too much effect on ground immediately, but the sentiment will change for Indian equities amongst the foreign portfolio investors. And we definitely expect a lot of them to move in as soon as the trade deal gets announced from the FII side. So I don't think Indian market is in for a major correction or anything like that because of the AI bubble, bursting at some point of time in US. What India will benefit out of the entire thing is, as and when the trade deal gets signed, FII money will start once again to come in by the truckload as far as India is concerned, and that will take Indian valuations at a different level. Remember, FII participation in Indian market is at kind of all-time low. If you compare last decade also, I think it's a decadal low as far as FII participation in Indian market. Now that will change, and the trigger will be India-US trade deal.
Sudip, great point. In fact, you said that, the Magnificent Seven tech stocks performance in the US market will in fact benefit the Indian IT stocks and the Indian IT sector. But there is one thing which will definitely have an impact on, the India market is, of course, the Fed's hawkish stance, which dampens, some of the precious metals. And, despite the short-term volatility which is caused by this Fed's hawkish shift, what is your long-term outlook, Sudip, for some of the precious metals, particularly from an India market perspective, given the recent buying trends that we also saw over the past couple of months, especially around the festival season and the local price moments?
Well, let's look at it in two parts. One is Fed stance. The Fed policy is on 10th of December. I think at this stage, the analysts in US are divided almost 50-50 between rate cut and not. There are multiple views coming from members of the Fed. It is, of course, a little confusing, but at some point of time, I think Fed will have to take a call based on the economy. Now, unfortunately, the data may not be coming because of the shutdown, and a lot of data which Fed normally works with will not be available this time. But I think Fed will have to take naturally a call on 10th of December. I won't yet, subscribe to the view that it's going to be a hawkish policy. Let us wait and watch. That's point number one. Point number two, as far as precious metals are concerned, we have to keep in mind one thing. There is, of course, a lot of retail buying and household buying of gold and silver as far as India is concerned. But globally, the demand for gold, silver, and the price of gold, silver, there is a bottom line which has been set by central banks across the world buying gold and silver, particularly gold. And that is not going to go away. Central banks across the world will continue to buy gold as their reserve. There are multiple reasons, and one of that definitely is diversifying away from dollar. And this trade has led to putting a bottom line on the gold prices. So to my mind, the gold prices, yes, it won't be a frenzy like what we did see a couple of months back or one and a half months back. But gold prices, it's not going to crash or come down significantly. It will remain elevated. Bit of correction, volatility here and there because of multiple factors we will keep seeing. But if you take a cutoff of a 1 year from, let's say, November of this year till November of next year, to my mind, and our analysis suggests gold will continue to move up. Silver will remain steady in spite of the recent correction which we have seen. There is industrial demand of silver because of the modern gadgets which are coming out uses a lot of silver, and of course demand of silver. So both gold, silver will continue to move up and provide decent return, not supernormal returns like what it did provide last few months.
All right, so that's the view from Sudip. David, I want to come to you. There is one theory that if there is going to be uncertainty in the global markets, one should put their money in commodities. He gave example of gold and silver, and there are quite a few social media posts from the renowned people worldwide. Do you think it makes a case to put your money in Bitcoin, in gold, in silver? And I'm telling about Bitcoin because it is off around 25% from the highs.
Well, now, I think I've heard a lot of good sense spoken about gold and about the Indian market, but I don't think there's any good sense in Bitcoin. I would not touch Bitcoin, and I would separate Bitcoin from what I am going to say. I won't talk about silver because it's a funny market, and I don't know enough about it. But gold, I will say, what has been said is absolutely correct. The trend in gold is going to continue to be set not by a fluctuation in the US interest rates, which I think, by the way, the Fed will cut again. It's not that. It's the buying by central banks. And what I see as a major driver of gold price is the creation of an alternative international payments and trade system by China using its payment network, which is extremely efficient and will be internationalized. This will create a renminbi trading bloc outside the US dollar completely, but it will throw off reserves. It will throw off surpluses, which have to be held like dollar reserves are now, except they will be held in gold. So I think the big pusher of the gold price in the next 24 months is the creation of new renminbi trading systems outside of China, trading in renminbi, accumulating value in renminbi, but a lot of that value will be stored as reserves in gold. That's number one. And that's, I think, the biggest change. Now, in the short term, there are a few things going on, like the Central Bank of Russia is selling gold because they're out of money. But I don't think that is going to outweigh what I've just said to you about the rise in gold as a percentage of global reserve holdings. At the moment, if you take all the central bank international reserves, gold is now 25%. I think in a year it'll be 30%. And I think the phenomena that I'm describing of a new demand for gold with a new payment system founded by China to get away from the dollar, I think that will be the driving factor.
betting big on gold, but not so much on Bitcoin. In fact, Bitcoin plunged to its lowest last week, and there is a technical signal which is implying that it might go 60% more on the downside in the coming weeks. From a macro structural viewpoint, how credible do you think is this 60% downside projection, or could it be simply an overreaction, David?
Look, I personally think that there's a huge difference between the fundamentals of gold, where you have about 4,000 tons a year coming on to the market from mining and other sources, and where you can see the demand from central banks absorbing 30 to 40%, maybe more, of that gold. And Bitcoin, which is based upon the fantasy that in some way or another, this thing has a value, when its only value is the network which trades it. There's no intrinsic value in the coin itself. And therefore, I cannot tell you how far Bitcoin will fall. But I think in a world in which bubbles are bursting, the bubbles we talked about in the beginning, I think Bitcoin is a natural candidate to be right at the forefront of losses. And I would not go near it.
Right, point well taken. But Sudip, I want to understand from you what is happening in India, because on 10th of December, as you mentioned, Fed will take decision. But before that, on 5th of December, Reserve Bank of India is going to meet. MPC is going to decide whether or not they are going to cut rates. And why I'm saying cut rates, because Reserve Bank of India governor today gave a statement that there is a scope. What is your opinion on that front, and how should one trade that?
Well, a couple of things. I think, of course, considering the inflation at what level it is, interest rates can surely come down. But one has to also remember that RBI inflation, band is around 4%. Now it has come significantly below that. Now this can also lead to challenges on multiple other fronts, and RBI will have to be extremely careful as to ensure that there is a decent inflation in the economy, because that spurs growth and that spurs economic activity. Now, we should not get into a situation where we have negative inflation and interest rates continuously coming down. So RBI will have to do quite a lot of balancing. There is, of course, an opportunity, considering that inflation is at almost all-time low. There is a possibility of bringing down interest rate, and one more a round of interest rate reduction definitely can happen. So I will carefully watch the space as far as what RBI does. Also, you have to remember the other very interesting facet of this entire interest rate scenario. Indian currency is under significant pressure, and we did see last Friday, it would have probably touched 90, but for RBI intervention, through which it was kind of not allowed to go beyond 89.50. Now, interest rate reduction beyond a point doesn't help the cause of stability in rupee. So RBI will carefully weigh that as well. So overall, again, even in India, though there is a case for interest rate reduction, I'm not very sure that RBI will take the plunge right now. They may choose to wait and watch. As far as Indian markets are concerned, I don't think they need a rate reduction for moving ahead now. The trigger for Indian markets have been and will continue to remain corporate results for the Q3 and Q4, and expectations are that results will be good based on demand, which has got stimulated significantly. Also based on the fact, as and when the US-India trade deal happens, FIIs will start investing. So I think these two will be triggers for Indian markets going forward.
Important issue, Ankur, which is looming large, on the global markets, of course, is, the Russia-Ukraine peace talks. Unlikely, a deal which is unlikely anytime soon. Like the sticking points for Ukraine have been to give up the territory, to cap its military size. Additionally, Ukraine would want like a clear, explicit security guarantee as a part of the deal that no further attack can happen. So having said that, David, given from your macro geopolitical lens, how do you assess the risk that a peace deal between Russia and Ukraine could lead to a rollback on energy sanction, and what would that mean for, the Brent's downside?
Well, if there were a deal, of course, there would be some relief for Russia on sanctions, but very little and very gradual. And I think the effect on the oil market would be very small. But I don't think there's going to be a deal. Let me explain to you why. This is the 28-point plan was cooked up by a California state agent, a Russian oligarch, and Trump's son, without even the State Department knowing what was going on. It was an attempt to actually get Trump back on track in supporting the Russian objectives for ending the war. And then it broke. And now it's being negotiated away by the Europeans and the Ukrainians, bringing to the table some sense of fairness, because the deal itself was probably one of the most disgusting things I have seen in diplomacy in my last 60 years doing this job. So my best guess is if this deal was imposed on the Europeans and Ukrainians, they would not agree to it. They could not. Then Trump would move out of Europe, NATO would collapse, and you would have actually a very serious situation in markets which would be faced with the astronomical costs of Europe ensuring its own defense and the enormous instability in Europe as Russia took advantage of the fact that Europe had no longer any US shield or protection. So I think Trump will back away from that. And I think the deal will actually be kind of watered down, still pretty disgraceful, but it will not do any of cross any of the red lines you said, such as, for instance, giving Ukraine too few troops and too few missiles to defend itself, or stopping it becoming a member of NATO, or giving away its territory. I don't think it'll do any of those things. And for that reason, this will be why it gets agreed between the Americans and the Europeans. But it is also the reason why Putin will reject it. And therefore, I don't think that means that you will either get the worst scenario of the breakup of Trump's support for Europe, or the scenario where Putin signs off on this deal. I don't think either of those are going to happen. So I would look to more exciting things to talk about in markets at the moment.
And one common thing these days in global markets is confusion. But I want to come to you, David, to understand what could be the favorable conditions for you to change your view. You are saying that uncertainty is there for next 6 months. Equity markets is something to be watched out for. But what could be favorable conditions? Is it just a Fed rate cut or more?
Well, look, I mean, that's a highly pertinent question. And I mean, the problem about strategists like me, particularly geopolitical strategists, is that they're normally very dyspeptic and pessimistic. And what you really have to do is to learn to ask yourself, well, what could go right? Now, I personally think Fed cuts are one thing, though you can't really run the whole world economy just in the hope that a central bank continues to cut interest rates, probably when it shouldn't. But I think the things that could go right would be a sense that the regulators had got a grip on the excessive credit creation, and that there was some sense creeping into the AI market, which made it look more realistic. So that in fact, you got a gradual decline in valuations and a gradual decline in asset values in excessively valued sectors. So actually the economy adjusted, the capital markets adjusted, not upwards, but actually downwards, but in a controlled and smooth fashion, so that you could start from a better, more sensible base 6 months from here. That, I think, is what would make me believe that, the world is not a bad place. But to be honest, that's what could go right. I think there are a lot of things which have to go right before the world stops going wrong.
A lot of things have to go right before the world starts going wrong. That's what David has to say about it. Sudip, your final thoughts before we wrap this discussion.
Well, as far as India is concerned, I'm positive. I think, as I mentioned earlier also, India-US trade deal is probably a done situation now. people are hoping, markets are expecting the same to be announced this week. As far as India is concerned, this will be good. If it doesn't happen, then probably we are looking at a loss of GDP to an extent of 0.5 percentage point. And that's not good under the circumstances. And we should expect the deal to happen. With this happening, I think, as I mentioned, Indian GDP will be on track and foreign investors will be back in India, which they have not been for quite some time. And Indian markets will move to a different level. So that's as far as markets are concerned. If you look at the economy, I think we are doing fine. The oil prices are under control. Inflation has come to almost all-time low levels. Interest rates are coming down. And the government has done enough and more to incentivize consumption, whether it's income tax relief for the common man or the GST rationalization. And we expect the consumption to pick up in a big way in Q3 and Q4. Initial signs of that are already visible. There is a challenge in terms of private capital expenditure, and probably steps are going to be taken to incentivize that. All in all, I think we are at a good position, and we will continue to chug along and will continue to remain the fastest growing major economy in the world.
We are in a good position, says Sudip Bandopadhyay of IndiTrade Capital. Thank you so much, David and Sudip, for joining us today for this conversation. Your insights were very helpful in making us understand, the entire volatility in the global markets as well. Thank you so much for joining us today. Well, it was a weak day of trade on Dalal Street as markets, after a range-bound trade for most of the day, saw a sharp sell-off in the last hour of the trade, with Brent favoring the declines. Broader markets continued their underperformance as small-cap index saw a near 1% cut, while mid-cap index also saw a near 0.5% cut. Sectorally, other than IT stocks, all the major sectors witnessed a sell-off, in fact, with realty and metal sectors being the top drags. IT stocks outperformed in trade, with Tech Mahindra gaining the most.
And moving on, important comments came in from Reserve Bank of India Governor Sanjay Malhotra, who mentioned that there is a scope for further reducing policy interest rates. He said there is a scope, but repeated monetary policy statement which was given in the month of October, where it was explicitly mentioned that scope is there, but how much RBI is going to cut, whether or not RBI is going to cut, that will be decided at the MPC meeting. If you look at the just data, Q1 CPI number has come in at 1.8%. In fact, overall, if you take the average of 3 months, it will come even below 1.8% mark. And the projection for Q2 and Q3 has been 1.8% by Reserve Bank of India in the last October monetary policy. And the actual numbers have actually come in much lower, with the last month being 0.25%. So it will be interesting to see whether or not there is lowering of CPI projections, and more importantly, if Reserve Bank of India is deciding to cut rates. And moving on, there is also an important bulletin which has been released by Reserve Bank of India, whereby it has highlighted that the inflation has remained below the target, as we were discussing earlier. And RBI has mentioned in the bulletin that inflation has moderated to historic low. My colleague Anurag Joshi is joining with more details.
Inflation has moderated to an all-time low. This is according to the Reserve Bank of India bulletin for November. The RBI said that the inflation has stayed below the central bank's target and financial conditions are benign and the credit flow is improving. Indian economy has showed signs of further pickup in the pace, and this economic rebound is despite the continuing global headwinds. The available high-frequency indicators for the last month show expansion in the economic activities such as manufacturing and services, and festive seasonal demand and the impact of GST cuts are showing in the economic rebound. India's consumer price index rose 0.25% year-on-year in October, and this was the slowest increase for the reading since the CPI series was started in 2012.
Thank you, Anurag, for these details. Well, it is time for us to slip into a short break. You don't go anywhere. We will be right back on ET Now.